So joining me today is the team from Van Isle Modern Mortgage Group. This is a brokerage under the Dominion Lending Centers. And we have this afternoon, Elaine, Leanne, and Rhonda. Say hi, guys, and introduce yourselves.
Hi. Hi.
All right, so who's who?
I'm Leanne. Oh. I'm Elaine. And I'm Rhonda.
All right, thanks for taking the time to join me this afternoon, guys. So just wanted to help some of my clients understand some of the changes that are going on in the marketplace. On June 4th, CMHC announced some changes that to their lending guidelines. Can you fill us in on some of the details of what these changes are?
Sure. So on July 1st, the changes are going to take effect with CMHC. One of the changes is that one of the borrowers, if there's two people on lending money, one of the borrowers has to have a minimum of a 680 credit score. So, and the other changes that are taking place is that there's what we call ratios. And you often hear them talk about the debt servicing ratios. And so this debt servicing ratios, in the past, they allowed to go to 39 and 44. And now they're going to only allow 35 and 42. And so that's going to make it a lot more difficult for people to qualify for, larger mortgages. Okay. They're looking at an approximate percentage of about 10 to 11% less of a house than before. Okay. So it is going to have a significant impact on the prices of homes that people can buy.
Mm-hmm. So in terms of ratios, now what exactly does that mean for somebody that isn't in the industry? What do these ratios mean and how are they calculated?
How ratios are calculated, there's two parts. It's called gross debt service ratio and total debt service ratio. And the gross debt service ratio is your living portion. And your living portion either it's include the principal and interest on a mortgage, or in some cases, if you're not a mortgage, it would be your rent. And then it's property taxes, heat, 50% of condo fees, and 100% of pad fees if it's for a mobile. And they won't let you, before they used to allow borrowers that have good credit go to 39%. Well, now CMHC is only going to allow them to go to 35% of their gross combined family income. So not your take-home pay, but your gross pay. And in the case of the total debt service, it takes all of your living expenses in that number, and it adds your consumer debt. And the consumer debt is your line of credit, your vehicle loans, your student loans, credit card debt. And they add it to the living portion, and they won't let you go over, up till now, up to 44%, but they are reducing that to 42% on July 1st. So it's going to have a significant impact on what consumers can do in terms of mortgage financing.
Yeah, okay. And now, so for someone that doesn't know, some of these terms are new to people out there, and not everybody knows who CMHC is. Perhaps you can explain a little bit about CMHC, what they do, what's meant by an insured mortgage.
Insured mortgage is a mortgage that is high ratio. It's when you have a down payment of 20% or less. So if you have 5, 10, 15, 20% down, and that would be considered a high ratio insured mortgage.
Okay, and so CMHC is involved in a mortgage as an underwriter, if I'm not mistaken. So what that means is they will insure the mortgage against default. Is that correct?
Yes, they take on all the risk. So the lender doesn't have to. You pay a fee like any other insurance, and that it doesn't really benefit the borrower. It just benefits the lender, so that there's no risk for them. That's why they usually get better rates for high ratio insured mortgage, because there's no risk to the lender.
Right? You get a better deal if you buy into the insurance.
Okay. So CMHC, is CMHC the only underwriter for mortgages?
No, there's two other ones. There's Genworth and Canada Guarantee. CMHC is government owned. The other two are privately owned.
Okay. So those a lender may use one or all three of that. Is that correct? Of those?
Yeah, usually they go between 1 to 2 of them. There's not very many lenders that use all three, but there's options because the other two insurers are still using the other ratios of 3944. They're not changing at July 1st.
Mm-hmm.
It's not to say down the road that they may not. I mean, they may change, but at this point, they're not.
Yeah. So that's the one good news right now is that if you don't meet the CMHC guidelines, there's an opportunity to seek approval through one or the other of the underwriters.
Yeah, there's other options.
Mm-hmm.
Yeah, oh, for sure. And that's why you need to go see a broker.
Right. Yeah. So you guys know who deals with which underwriters, and you can be you can present the borrower's case to the appropriate lenders that way. Is that correct?
That is correct. Yeah. So yeah, we know who's using all three and where we can place it.
Mm-hmm. So let's talk about some real numbers. So I mean, the percentages are good to understand, but I don't think a lot of people can think in those percentages. But let's say somebody with a good credit and with a combined family income of 100,000 that are looking to buy a home right now. What do these changes mean in terms of how much they can spend in real dollars?
So combined income, say, of 100,000 at the 3944, the existing ratios that we can use, mortgage amount is about 479,000 thereabouts, right? Don't quote me on that. And once the changes are in effect on July 1st, that 479 that they qualify for now becomes 425,000. So quite a difference.
50,000 in difference there. Yeah, that's quite significant, especially if you're looking in the $400,000 to $500,000 price mark for a home. That can, you going that 50,000 can make a difference in the quality of home that you can buy. Yeah. So okay. The other number that you had mentioned was the 600 and the 680. That's a beacon score, if I'm not mistaken. Can you explain maybe what a beacon score is?
It's a credit score that is reported every time somebody uses a credit card or applies for a mortgage or ends up with a vehicle loan. These different credit facilities report to two different credit bureaus, Equifax and TransUnion. The 600 is 600 and 680 are credit scores. So up until July 1st, CMHC would allow us to even send in deals as low as 600 for a credit score. Well, now starting on July 1st, they will accept applications, but the applications, at least one of the borrowers has to have a 680 credit score or better. And the other thing that they will look at too is the amount of debt. So if the consumers have a lot of debt, even if you do have borrowers that have over 680, there's still a good possibility of getting declined if you've got high debt. So it's important to know that if you have a limit on your credit cards of say 10,000 on a credit card, the max they like to see someone having for debt is about 50%. Once it gets over 50%, your credit starts to drop more and more and more. You would see even credit scores drop 30% if they were right to the max. That's the kind of impact it would have. So it's extremely important that when these applications do come in after July 1st, that all of that is noted.
Mm-hmm.
So
so that's some of the things that you do with some of your clients as well, is to coach them through how to improve their credit score, how to make their case the best possible in order to get approvals. Is that correct?
That's correct.
Yeah. So yeah, we'll have to do another episode at some point in time. We can talk about some of the factors that influence how a borrower can improve their chances of getting approved, and whether they're looking to buy a home right now or whether they're looking down a year or two down the road. Certainly wouldn't hurt to have some of that information in hand so they can work a plan.
We do a lot of working with people, explaining to them so they understand what has to be done, and getting their credit score to 680 so they can buy a house.
Yeah, there's a lot of learning. But if anybody even wants to, have a quick idea or anything like that on their own, on the Dominion site, there's a My Mortgage toolbox, and it takes into consideration, put the income in there, any credit card debt or anything that they might have, and it does a valuation on the property taxes for the city that they're looking in, like all of that, sweet income or not, and they can get, a rough idea of what they qualify for.
Yeah, no, that's perfect. Yeah. So thanks again for meeting with me this afternoon, guys. Really helpful information here, and we'll see you in the next one. Have a great afternoon.
Thank you.
Okay.
Bye.
Bye-bye.